Should I pay my car off before buying a house? This is one of the most common questions that we get asked. In fact, I even shot a YouTube video that you folks enjoyed so much that I figured I'd shoot a longer video, go into a little more detail, and tell you a couple of stories about a couple of clients with their scenarios, and hopefully you can learn from one of their mistakes so you don't make the same mistake the next time you're looking to buy a house. Now, there's a couple of ways to look at this whole buying a car situation when it comes to buying a house. The first scenario is, should I pay my car off before buying a home? Now that depends. The first scenario that we are going to discuss is paying off your vehicle. Now, to some, this might sound like a good idea, but there are instances where this can actually backfire and hurt you. And I'm going to explain to you why. So let's just say we have Johnny. Johnny is a borrower who's looking to purchase his first home, but Johnny's got a car payment. Now, how do we figure out what Johnny can qualify for? Well, here's a couple of things that we're going to look at. If Johnny were to pay off his vehicle, what typically happens when you do that is your credit score drops. And the reason being is because your car loan is an installment loan. So let's say you finance your car for 60 months. While you're paying on the vehicle, you're paying on time. That's a good thing. It's going to report to the credit bureaus that you aren't late, which is obvious, and that's something we want to avoid. So now, as you pay off the vehicle, that entire 60-month period that, let's say, you financed the vehicle for, if you go and you make that final payment, that trade line no longer exists. So that is why paying off a car is not always the best thing to do. A lot of you think that eliminating the debt is a good thing because you might have bought a $80,000 vehicle and you're looking at it in the frame of, well, hey, I paid this car for 6 years. I was never late and I was able to pay off $80,000 worth of debt. That's a good thing. And you're absolutely right. That is an amazing thing. But when it comes to finance, when it comes to your credit, that's not a good thing at all because now you just eliminated the entire trade line and it no longer exists. That's why if you look at a lot of articles about maintaining a high credit score, they always say never close out any trade lines because you're eliminating the credit utilization, you're eliminating the credit history that you've had. So that entire 60-month period that you may have been paying for that car is all gone. That's why it's not always the best idea to pay off the vehicle. So in Johnny's case, Johnny has a couple of options. Johnny could potentially pay off the vehicle, but how soon is he looking to buy his house? That is why I always stress to you folks that when you are thinking about buying a house, get with your lender ahead of time. This could be a conversation that you could have with your loan officer 6 months or even a year before you start your actual buying process. Because if you, let's just say Johnny didn't talk to me ahead of time, paid off his vehicle, and let's just say he had a marginal credit score, call it a 650. What if he paid off his vehicle and he lost 40 points, 50 points, and now he's got a 600? That can hurt him. However, what if Johnny has an 800 credit score? Losing 50 points off of an 800 credit score doesn't hurt you so much because you still have a 750. And I'm just using 50 points as an arbitrary number. The amount of points that you can lose is all going to be dependent upon your credit profile. And I've tested this myself because I paid off one of my cars several years ago, and guess what? The credit score went down. So I just wanted to see if that was truly the case. And yes, that really does happen. Now, if Johnny is smart and Johnny has marginal credit, Johnny's going to speak to his loan officer ahead of time. The loan officer is going to give him guidance as to how he's going to treat the car payment. Now, if the debt to income ratio is too high and we absolutely need to wipe out the debt payment of the car, that is an option. We may need to look at that. But we have to take into account what the credit score is. That's why it's so important to make sure that you have your ducks in a row when you're ready to buy a house. I've had a lot of clients in the past think that paying off debt, closing accounts are going to help them. We pull their credit score and the scores drop. They get mad. They think that I did something to their credit when all I did was pull it. You have to remember, you have to treat your credit properly to help you get into a house, especially if you have marginal credit. If you have high 700s, 800s, hey, you have the room for error by just doing whatever you choose to do when it comes to buying a house. But for the majority of us, if we're under 700, we need every point that we can get in order to get us into the best situation into buying a home. So now Johnny clearly understands what he needs to do when it comes to buying a house. Does he pay his vehicle off? Does he not pay the vehicle off? That depends on what he can qualify for. Now let's talk about another scenario with another client named Brian. Brian is leasing a vehicle and Brian's looking to purchase a home. Now, a lender looks at a lease differently because more often than not, when you get done with your lease, you are going to lease another vehicle. So again, if you are in a car lease right now, and depending on what your DTI is, I would strongly suggest talking to your loan officer because again, we need to factor in that lease payment. So, and even if you're thinking about trading your car in, remember, we still have to factor in some sort of vehicle payment for you. So make sure you talk to your loan officer, be smart like Brian, get ahead of the problem so that way you can best structure your deal in order for you to buy a house. Now let's move on to our third client. Her name is Erin, and Erin is a co-signer on a car loan with her brother. Erin's looking to buy her first place. Can we or can we not omit the debt from the credit report and the qualifications of buying a house? What do you guys think? In fact, comment below, let me know what you think if we can omit the debt against qualifying Erin for her housing payment. And by the way, if this is the first time that we've met, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your homes all across America. Whether you are a first-time home buyer or you're an investor looking to build your portfolio, I've got you covered all across the country. You can hit the description below for links to more information on how to get your mortgage right. And don't forget, I drop content every single week. So if you like this video or want to learn how to get your mortgage right, make sure to hit that subscribe button so you can get all the latest content that we put out. Okay, so are you done answering? Now, can we omit the debt? The answer is yes. If Erin's brother co-signed on the vehicle with her and we can show that he's made 12 consecutive payments out of his own bank account, we can omit the debt from Erin being able to purchase the home. So again, you might have co-signed for a brother, sister, family member, and that debt could have potentially held you back from buying a home. There's ways to get around that. Again, make sure you talk to your lender so they truly understand what you're looking at. So that way, you're not rushing out to go pay off the car loan, thinking that again, you're doing the right thing so you can get rid of the debt. You can simply show the 12 months of bank statements of your partner or co-borrower who's making the payments, and the loan officer can omit that from qualifying and help you get into your next home. And last but not least, I'm going to tell you about my own scenario, which I didn't take my own advice the last time that I was looking to buy a house, and I went out and guess what I did? I bought a car. Yes, I went against my own advice and I bought a vehicle. However, I knew that I could qualify for the mortgage, and I knew the steps that I was going to have to go through in order to keep moving forward with my home purchase. So if you're going to make a mistake like me, go out and buy a car during the middle of your transaction, make sure that you can qualify for the new car payment. Again, I knew I could qualify. It wasn't an issue. I was getting a deal on trading in an old car, got a bunch of money for it, and decided to buy a car that I've always wanted. So that happened. Now, I had to document my new car payment to my lender because it wouldn't show up on the credit report. So I just had to send them the information as far as what my car loan was, so that way they can factor that in. Now, I've talked about fraud and all the stuff that's going on in the mortgage industry before. Don't think that you can go buy a car and just because it doesn't show up on your credit report, the lender's not going to know. The lender will know because they do monitor your credit report so they can see if there's any inquiries that are taking place. Again, I didn't take my own advice. I wanted to go buy this car. My lender knew about it, bought the car on a Saturday. Of course, Monday morning, they sent me an email. Sean, what is this credit inquiry about? If there's any new debt that you incurred, we need to know everything about it. So of course, I knew that was going to happen, and I sent them all the car loan docs, and of course we qualified, moved forward, closed on the house. So make sure that, again, if you make a mistake like I did, you have everything ready to go, and don't be upset if your loan officer calls you the next day asking you for all that information. Now, my wise advice to you is, if you are thinking about buying a car and you really want to buy a house, I think you have to choose between the two, unless, here's a caveat, unless you make a lot of money, you got the income to support it, then hey, go ahead and treat yourself and buy the car and buy the house. If your DTI is tight when it comes to qualifying, I would strongly suggest you waiting to buy your vehicle after you close on your home. Buy the house first, because again, I've actually told a story about a client who decided to go and buy a car before she bought her house. She actually lost $100,000 worth of buying power simply because of the amount of debt that I had to take into account for her car payment. So don't make that mistake. And especially, you've seen all the equity that people have been building over the last few years. You go buy a car for 50 grand, guess what? You're losing money. Now I know used cars are becoming more valuable today, but think about if you would have put that 50,000 towards a house, and how much is that house gonna pay you back in appreciation over the last several years? It's been insane, the amount of appreciation that we've seen across the country. So my wise advice to you is buy the house first, get your ducks in a row, then you can go buy the car. Because most car dealerships, they're gonna give you financing regardless of what your credit score is, but you can't necessarily do that when it comes to getting a mortgage unless you've got a ton of money to put down. But for the average person that's looking to buy, we need to work with what we have available. And the last thing I'd hate to do is see someone lose the opportunity of buying a home for simply chasing down a car that they wanted. Now, after watching this video, what do you think you should do when it comes to the car or the house? I hope you take my advice. And if you still have questions, don't forget, you can still check out my playlist to learn how to get your mortgage right. And I'll see you on the next video.